Hi everyone, this is Paul Lang from DTS, and I want to introduce you to what you're about to watch. This is called an impromptu event because it was kind of last minute notice, just like a 24-hour notice. Normally these are 30 minutes long, but this is a special one that I advertise to be 90 minutes long. There's 3 topics in here. It's a market review through the eyes of a letter that I put out every morning. It was a review of an email that I sent out shortly prior to this event that I think is a very important topic if you don't watch anything else in here. And the last part, fair warning, is a partly educational but mostly discussion about the DTS Long Term Trader, kind of a question and answer with a lot of questions people have about it. If you enjoy this, check out the many other full videos of educational events, articles, and Trade of the Week videos. You can get full access to these at the DTS Free Stuff page, which you can find if you go to the home page. For now, sit back and enjoy this event. Welcome to tonight. Welcome everybody who's here and those that will be showing up a little late like most people do. We ready for tonight? If you read the email, which most people probably don't, I am going 90 minutes tonight. Didn't want to run way over. May not go that long. I don't know. It depends how it goes. The first topic is going to be a long one. The last one will be a short one. The one in the middle, I'm not really sure. It depends how much you guys want to talk about it. This is called Market Review and 2 more. There are 3 topics for tonight. You saw the email, I'm sure. And I'm sure you're only here if any of those topics happen to interest you. 89 minutes long market review plus 2 more. 3 things we're going to talk about. Thought I put them all on one slide. I did not. We're going to be a market review first of the last 2 weeks. It's actually the last 3 weeks. I said 2. It's going to be the last 3 weeks, and that is with a now time of like this weekend. So it's the last 3 weeks basically of February. Kind of the last 2 weeks. Maybe it's 2 or 3. I don't know. So it's going into the end of February. Taking a look at market action. The second topic, of course, is going to be a review of the email that I sent out because I think it is one of the most important topics, and I think most people don't get it or are stubborn about it. And this is kind of, I always like to divide things up when I talk about things that are absolutely fact and things that are somewhat opinion. This is somewhat opinion, and I respect anybody who doesn't agree with part of what I have to say in that email, the conclusion of it. Not part of it is very objective, though, and you can't disagree with. And then third, I want to review long-term trading, and specifically, it's going to be more of kind of a question and answer ad for the long-term trader, but there may be some educational moments as we go through that a little bit. So let's begin right away, and this first part is going to be the longest, and this is a market review of the last 2 weeks. This will be a review through the eyes of the DTS Daily Market Letter. What does that mean? Well, I'll explain why it's through the eyes of that in just a minute. It'll be a very educational look at how the daily market bias is formed or traded. Let's run through some 60-minute charts over the last 3 weeks. See, it is 3 weeks. This is a day trading bias. The 60-minute chart is the parent time frame for day trading. But all the education here applies also to long-term as well. The weekly chart is the parent time frame for long-term trading. So let's talk about that for a second. A lot of people say if you're scalping, you can use the 15. Yeah, the 15 and 60 are not going to say anything different, really. They're pretty much the same time frame. They're not that far apart. Either one is fine. And what that means to be the parent time frame is actually quite a long story if you want all the details to it. But what it basically means for the simplicity of what we're going to do tonight, it means that you can't violate what the 60-minute chart is telling you, in essence, if you're day trading. That actually gets to be a fairly complicated answer. It's not quite as simple as if the daily chart's in an uptrend, you stay long, downtrend, stay short. It's not really, it doesn't translate that well. It's not really accurate to say that. But it is the parent time frame that determines what you can and cannot do. So let's just kind of start off here and take a look at a chart. Now, this is the hourly chart, the QQQ, which I usually look at for the market. I look at the QQQ and the SPY, the S&P 500. The QQQ, by the way, in case you're newer, is the ETF for the NASDAQ 100. It is the chart of the NASDAQ 100. The SPY is the ETF for the S&P 500. It is the S&P 500, tick for tick. And I also look, not on an intraday basis, but daily, I look at the IWM, which is a small cap index, the Russell 2000. So when I have to look at one chart to do what I do, I use the QQQ because usually the QQQ and the SPY are similar or the same. When they're different, neither one is necessarily correct, but if anything, the QQQ tends to lead most times. So that's why I feature the QQQ on charts. So this date down here, if you can't read, is February 5th. And I put a daily chart here because you really need to have the daily chart to understand the hourly chart. And you'll see that in the very first trade thing here we're going to look at, or the first bias. This is really, for me, every day I do this to determine an intraday market bias. Now, if you're trading the market, If you're trading market futures, or you're trading the same day puts or calls, or you're trading the triple QQQ, or the TQQQ, or the SQQQ, all derivatives of the market. If you're doing any of that, then naturally you have to have a market bias because that's what you're trading. For me, I sometimes trade the market futures, but usually I'm trading stocks, and I like to know the market bias as a backdrop. If everything is going to be being sold today, there's less of a chance that the average stock is going to go up. Now, there's a lot of asterisks next to that because some stocks don't care about the market. Some may be counter market. I don't know of any counter market stocks at the moment or sectors. I know more than usual, they're just kind of on their own. But does that make sense in general that if money is leaving the market in a big way, that long is probably not the best odds? Does that make sense as a general comment? A lot of exceptions to it, of course. And of course, the reverse. If money's pouring into the market, it tends to, fill all the buckets and tends to lift most things. But again, there are exceptions. So I want to have that market bias in my back pocket. So here's what we're going to do. This particular day, the market is going to gap up a little bit to right about in here. So if you were writing a letter to yourself, which by the way is something I'm going to recommend you do if you're day trading, is write a market letter to yourself. There was a period of time, but right before DTS for about a year, where I was just on my own trading, and I found it to be incredibly helpful to actually write a market letter as if I was writing it to people, because you tend to have a much different opinion of things if you just glance at the charts and say, yeah, yeah, yeah. And if you write something that other people have to rely on, because all of a sudden you become much more accurate and you see things that you might not have otherwise seen. Yeah, thank you, Eric. Yeah, very true, and it'll change how you look at things. So there's a good comment for all of you. If you're long-term, write a letter about the weekly chart of the stocks you're on or the market. If you're day trading, every day write a little letter. If you're writing to yourself, it doesn't have to be super fancy, but get it on a chart, put some markings, put it on a piece of paper, dictate what you think is going to happen. And it's important you do that because it's funny how our mind plays tricks on us. I see this like in the trading room all the time. People once say one thing and it does the opposite, and then they say they were right somehow. I don't know how that happens, but we all tend to do that a little bit. It's kind of like you have both views in your mind, and when one of them comes true, you say I was right, but did you really do anything with it other than just kind of pretend you were trading it? So write it down, put it in stone, and it will contain a lot of if-then comments. You can never really just say, well, you can sometimes, so it's not really accurate, just say, oh, the market is higher today. Typically, it's like, if we open here and the market does this, this, and that, and then it does that, then it's definitely higher. In general, you can say, I think we're going to have a bullish day today, but it doesn't help you to say we're going to have a bullish day if you drop for an hour and then you rally the rest of the day, right? So all this precision is very much necessary. So if we were to open right here, what would be your call for the day? Somebody give me some things. By the way, I'm going to go through 3 weeks, but believe me, we're not going to do this on every day or we would be here till 2 o'clock in the morning. So I want to start off very detailed, get your input, then I'll kind of stop asking for input and I'll just give you the bottom line. You're day trading, here's where the market's going to open. What's your bias for the day? You have to write a letter to yourself. Dear me, here's where I think the market's going today. Go ahead. Now, not all at once. I don't want you to flood the screen. You might crash the room here. Is it bullish or bearish? What would you want to see happen? You can't click on this and give me numbers, but you could just say that's February 5th is the last day. You can just say the high of the last day, the low of the last day. Hourly chart's going to close up, close down. What do you think? Okay. So you mentioned the daily chart, even though I'm on the hourly chart. Yes, that's why I put the daily chart there. The hourly chart can only be perceived properly through the eyes of the daily chart. In other words, if I just looked at the hourly chart, all I would say is we're in a downtrend. How dare you even consider going long? But then we look here, and we happen to be right here in this particular day. Now, are we at major support? No, we're not at major support. We're really at a big fluffy nothing. And if I draw this line straight across, we're below this, we're above that. We're just in some big sideways sloppy pattern, which may or may not hold that particular day. So the daily chart absolutely is part of the equation, but I'm not sure how much it helps us exactly that day. We'd be interested in how market reacts to prior day's high. Okay, interested. So your translated comment would be, I wouldn't do anything with the market until it ran up and tested it, and then pull back and then do something. What if it opens and just blasts right through that? Do you think that's a reasonable? It always comes down to the question. You can always just say, I'll wait, I'll wait, I'll wait. And if you do that every day, you'll miss, you'll miss, you'll miss. So you have to pick the days where you say, I think the odds are I'm good to go. Just, good to go. That's not going to worry about it. And there's times where you got to say, hey, I really want a lot of security, a lot of confirmation. Anyone else have any comments here besides VRL and tag? What would you think the market's up or down the next day? Are there any other clues on the hourly chart? Okay, I'll take over because everybody's being a little quiet. That's fine. Here's several things that I would look at, did look at. Okay, yeah, that's one of them, VRL, a little bit, is that we're getting a little hyperextended to think short anymore. Now, that's a very vague, subjective comment. But here's something that is not vague or subjective. It's this prior day. Did anybody notice that we flew lower, did an immediate reversal, and then held that prior low? That's not subjective. That's a very objective thing. It's happening somewhere on the daily chart. I'm not sure, you can't pin your hat to it, but I do want to see the reaction to that extended pattern somewhere in this vague area of some kind of daily support. And I think this is good enough that since we're going to open up a little bit, I think it's good enough to say if we open there, if we open beneath that prior high, if we open beneath that high, I think we're just good to go higher today. Boom, pedal to the metal, don't worry about it, who cares? Anybody agree with that, disagree? Agree, disagree? Like it? Don't know? Well, here's what happened. Boom, we opened right where I said, and we basically just flew higher. Now, I'm not pulling up the 5-minute charts and all the stuff. Yeah, you can cheat if you want. I don't care. You're not getting paid for this. That's right. And we just flew higher. If I remember, I think if you tried to wait, you would have kind of missed this. I'm not sure. Maybe not. You probably had an opportunity to enter in here somewhere. But despite the hourly chart downtrend, I think, and as I said, I think it would just fly higher, and we actually did that day. Yay, yay, Paul. What about the next day? What are we going to do on this next day now? So now we have a big day up. Are we in an hourly uptrend? Are we still in an hourly downtrend? Is the daily on this day, which of course the daily now would be after that green bar, would be right, it's the end of that green bar right there. We left a pivot beneath us. Is the daily chart off support, uptrending, downtrending? What's the hourly chart going to do the next day? Broke 2 pivot highs on the hourly chart. So VRL is saying that here on the hourly chart, this rally was enough that we took out this and we took out that, right? And anytime I look at this, I usually have kind of a bias saying, I think we're going higher in general. I think we're going lower in general if this or this happens. But there's a lot of days where you have a bidirectional bias. In other words, I could see if XYZ happens, we would go higher. And if we have proof the other way, we could go lower. Now, this is a day, because we are still in a daily downtrend, and we really just got overextended on the hourly, this could be just kind of a short covering thing. It could be a little blip in the radar there. And I think that it would be possible that if we had like some kind of confirmed move under this area, I think it's possible we might have a partial pullback that day. So I think if we open strong, remember we had this big rally all day, so I think if we open strong, I think we may pull back to this area. But if we open weak, I would be good to go again, just boom, almost off the gates if we start moving up, because I think we're going to have another decent-sized day up. What actually happened? And any other clues there? The only other clue is what VRL said. We took out those 2 pivots there, really. That's about it. And all that is the same as the day before. So here's what happened. There we go. We opened down, and we just plowed right through everything, the opening hour, whatever. I was right again. How impressive is that? That technical skill. How impressive is that? Be honest. Man, Eric, you got memory. I haven't done this in like 3 years, Eric. You have quite a memory. If you guys think that's impressive, Eric and I would both actually, we're co-owners of the Golden Gate Bridge, and we like to do a timeshare with you. You could all have the Golden Gate Bridge for 1 day a year. Anybody want to sign up for that? That's not impressive at all. My dog could do that. I'm just the average idiot out there live talking to you, looking at a chart, looking at past tense, and going in explaining why something happened after the fact. If I would have done the opposite, I would have said the opposite and explained why. Right, Eric? Nothing impressive at all about what I just did. And if you ever hear somebody talk like that about why something happened in past tense, just tune out as quickly as you can. So why am I doing that if I think that is so terribly unimpressive? Well, what is impressive is if you can make those comments before the market opened. There you go. So on this particular day, this is a daily market letter I put out. It goes out at 8:30 in the morning before the market opens, an hour, everything's Eastern time here. And here's the quote I wrote: if we open above blah, 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 if we open below 602.30, trading above 603.50 is long. Now, you don't see all the numbers. It was basically saying if we open what we did, taking out that prior pivot high, just good to go long, period. And then the next morning, when whatever happens, happens, I put a little, it doesn't say it here, but it says even if subjective. I put my own analysis of how it was. And I put excellent homer, because it was a homer. It was the only thing. Now, normally I'll have multiple ideas. There could be different areas to go long. Many days I'll have both a long and a short choice, because I'm not even real sure where the market's going to open, keep in mind. And I also don't know what the opening bar is going to do. So I'm trying to send a letter out to traders about this. And I have a motive for doing this, and it's not what you think, believe me. So the next day, and we did this also. And the next day, I said, if we open blah, 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 blah. We said, excellent. If we open below 610, trading above 611.55 is long. So it looked like we were opening a little bit weak. And because we were so hyperextended on the hourly, because we're coming off some area on the daily, notice, you can see, if you look in the future here, when I keep saying some area, the daily didn't go very far. So you got to be careful. That's what I mean. It wasn't really a major support area. It actually is a weakening daily to some extent. But nevertheless, we're just in the first move off the bottom. And we are, in general, in a long-term sideways market. If you just squint your eyes, which I like to say a lot in technical trading, if you just squint your eyes, wherever you want to draw your lines, it really doesn't matter. We're sideways for 4 months, and we're near the bottom, and we bounced. That's all you need to know, bigger picture. What's the outlook now for the next day, though? This gets a little tougher. What's the outlook for the next day? We're now 2 days up, still in a daily downtrend. And the hourly chart now is almost a little extended. I know a lot of traders like you. Given the circumstances, the market, and the news that we heard, the market is very likely going to be higher today unless the news that we heard is reacted to and the market ends up heading lower today. People actually say stuff like that. The market will be higher unless, when it goes higher, we encounter those sellers and the sellers come in and drive things lower. Then we'll end up lower. Outlook for today, several things, for clues on the chart. Number one, we are sideways on the daily maybe, but we're coming into this area, which is going to be a little bit of resistance sort of thing. We're coming into this area in the hourly chart. We're extended up 2 days. All these things come together to get your bias. I'm not willing to go long the next day. Matter of fact, here's what it said. I didn't even know I said this. I'm going to let the long side go today. I didn't realize that was coming up. I don't study that well. As I think it'll turn into a sideways pattern if we try to go any higher. Now, that's pretty impressive. I'll admit that myself. If we open below 615, below 617, trading below 613.85 is a short. If we open below 612 or below 615, the new low of the day is a short. So only short calls on this day and pretty tight ones. What happened? Well, we moved lower. Very good. I mean, there wasn't much movement. And again, making these calls before the market even opens, that's as good as it gets. Very good. By the way, these ratings, as I go through the 2 weeks, I'm going to pick it up. If you're getting bored, I'm going to pick it up very quickly and make my point soon. But on all those ratings, there are several days where something just didn't happen. There's a couple days I don't make a call because I just have to say, a little too clueless here. I don't want to make a call. There's some days I make calls and they don't trigger. Whatever I said is going to happen doesn't happen. So there is no call per se. Some days the comments are excellent, but the call wasn't right on. Like I may be very bullish, but say if we open blah, 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 and the first bar turns red, but the first bar just goes green, and we take off. So sometimes there's just not a call. There was one day where I got a zero, terrible call. Just was the wrong, bias went the wrong way. Out of all these days, I think there's only one in here. I'm not sure if it's coming up here or not pretty soon, but pretty soon. So now we have this 2 day up thing, and then the rollover a little bit yesterday. What do we call for the next day? Well, the next day was a bit of a botch because the next day, if we open below 612, there's a long, blah, blah, blah. Here's what happened the next day. We were supposed to open flat, and some kind of news came up, and we gapped way up. But it does say that if we open below 612, trading above 614 is long. And finally, the 35 minutes is below, the middle is a short, okay. But we ended up gapping up, and we just kind of came to the support level and went there. So that was kind of, you know, out of the realm of what was under consideration, because we were not supposed to gap up to there. And I know we're gapping up to there, and I think that day I would have a bearish bias, because we have the same kind of extended pattern. And notice that this is your intraday support level. That's your minor support level that held right to there as perfectly as you can expect anything to hold. So it says we end up gapping up a bunch, making the numbers out of play. I have some more to go through, but I just want to kind of make my first point here, is that the point here is that this is done before the market opens. There's no reference points on the current day whatsoever. This is just from the prior day's stuff. No, pre-market data is irrelevant, other than knowing where we're going to open. And yes, it gets easier as the day goes on, usually. I mean, once the market opens, every 5, 10, 15, 30 minutes that goes by, you have more and more bars on the chart giving you a little bit more information. What happened when we rallied above the high, what happened when we came up short of the high, and all this information can help make your decision. However, some days the move happens the opening 5 to 30 minutes. And if you're not ready for that, you miss the whole day. There's some days where after 30 minutes, I've got to shake my hand and say, I don't know what to do. So as we go through the other days, I'm going to pick up the pace and just kind of bottom line it for you. But I just wanted to give you a sense of something, and then I'll make my point here as we come toward the end. So now we had this big gap up this day, a sell-off, and we came back most of the way. Let me see if anybody has a comment for this day here. Take a look at it for me. What's the bias going to be for this day? We're going to open flat. We're going to open right inside that closing area right in there. Nice sell setup after a bearish wide range bar. Anyone else want to comment on that? He is saying that we have this big red bar. We came back and we have a sell setup in there. Was the retracement good? Was it too far? Does the daily chart help us at all yet? At that 615 level. Yeah, bigger picture, you know, the daily chart starts to not help us much in here. It starts to not help. We're at 615. Hang on a second. Yeah, so we are, because I can't read it, we are in the daily chart. We are in this area encroaching into here. Now, that's a tough call to some degree. There's going to be something there in resistance. It's maybe not a great minor resistance area, but there's definitely going to be something there. So we have a daily chart that's affecting us, and the reaction to the gap up to be sold that hard makes me have only a bearish bias. VRL is actually correct. Big red bar, bearish bias. I said for the day, if we happen to open weak and trade above this, in other words, that strength, I have a weak open and trade above this, I'd say long. But if we open below, blah, 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 but if you open below but above this, it's a short. If you open anywhere blah, blah, opening one red, the new high is long. So the short call actually caught that day. Mega home run. If we open below 615.50 but above 1635, trading below 612.75 is a short. They captured most of that whole day, and VRL really had it. That's just, you got to kind of play it that way that day. Now, keep in mind, like I said, if I just show you this chart up to that day, back to there, and I don't tell you we're going to open, I mean, that makes a big difference. If we were to open here, that would be extremely bullish. Now, why would just that small difference in opening, why would that make such a big difference in the chart pattern, everybody? Why would that make such a big difference? St. Paul, it's just a couple, I mean, it's not even 1% of the QQQ, just a small little difference in the open. What's the difference? Yeah, it's like I like to use that analogy of throwing a ball on top of the roof sometimes. You know, here's the top of the roof, and all momentum is down, no question we're doing that. But if you happen to throw the ball a little too far and it goes over the top of the roof, guess what? It's going in the backyard. Totally the opposite direction from what you thought, but probably goes just as far. When you cross that line, all of a sudden, all these people who have this short bias, they're all wrong. They're all wrong. And I don't care if you have puts on the market and you buy your puts, does that affect the market price? Or if you have futures and you short and you buy your futures to cover, does that affect the market price? If you have the QQQ and you're short, does that affect all the stocks in the QQ? Yes, they're all absolutely mathematically tied together. So it doesn't matter how you're short. If you're short and you got to buy, you are buying all the stocks in the market one way or another, because everything is given to you through some derivative sometime. The QQQ is simply a exchange-made symbol. where whoever made it up, whatever firm, whatever company made up the QQQ. I think is it Invesco? I'm not sure. I think it's Invesco. What they simply do is say, hey, look, we'll sell you the QQQ, and all we're going to do is when we sell you that we're short, we're going to buy all the stocks in the QQQ, so we're just at a dead even thing. So when you sell the QQQ, they're buying it, they got to sell all the stocks to stay equal. They're not taking the other side of the position. They're just doing a convenience for you and letting you sell buy a single instrument from them. So everything's tied together. So it doesn't matter how you're short, everybody else has to cover. And since there's some momentum going to the upside, even though it's stalled here, you're going to start flying higher without a doubt. So all those things have to be taken into consideration. So there were possibilities for long plays. Market never did it. The short was a mega home run. I don't use that term often, but it captured that whole red bar and or end of the day. And by the way, this is not, I talk about later, just so you know, this letter, it's not a tracked service. It's just an informational letter to you with a guide of what to do. It's not tracked. It's not like, you know, what I say here doesn't matter. It's just a general concept. Hey, how well did it do? If you held the end of the day, great. If you sold after the first half hour, great, whatever you did. So it's just, you know, just an informal thing here, even though the comments are pretty specific. So then the next day, here we go again. What are we going to do the next day? While it is lower odds, the best trade is if we do drop between 590 and 600. If the opening 5-minute bar is green, the new low is a short. If we open between 600 and 675, trading below 590 is a short, blah, blah, blah. And the opening short trade triggered and failed. So here's the one that blew it. Here's the trade that just, and again, when I say failed, there's no, I'm just telling you the bias. There's no stop or target or anything like that. But clearly, if you took the short this day, it didn't work very well, whatever you did. When you say long or short in the DML, does that refer to where you think the closing price would be relative to the open, or you're predicting a move? Predicting a move. Predicting a tradable move tag. Yeah, just predicting a tradable move. If you did what it said with reasonable, but that's just it, the manager's on your own. See, again, this is not, and I'm not even here asking anybody, I don't want anybody to subscribe to this, I don't care. This is kind of a unique letter. It goes out mostly to people who are day trading but not in the room. A lot of people in the room have it and they like it. I don't think anyone's ever unsubscribed from it, to be honest with you. I mean, people take trials, but I mean, I don't think anybody's ever unsubscribed. I'm not sure. But it's kind of a unique little niche. I'm not here at all, just not at all to sell this. I don't care less. I'll show you my point in just a second when we get there. But again, it's just what I call soft calls tag. It's just soft calls. It's like, hey, if we go over this, be bullish. That's what it's saying, basically. I give numbers the best I can to give you some, you know, relative concept. So we can keep going. The next day, huge homer. The next day we were gapping down. If we trade below 595, trading above 596. That's pretty precise, by the way. I want you to notice some of these numbers. We closed here. We were gapping down somewhere around 596. If we trade below 595, trading above 596.50 is a long. Why did I say that? Well, look at the daily chart. We're down here. We're retesting that area that day. We had that hard sell-off. We're coming into this area from over here, and we puked out in the morning. It's amazing how many times the higher low of the day, some of you know this in the seminar program, is set at the 10 o'clock reversal time or 9:35 reversal time or 10:30 reversal time. And I believe that was a 10:30 low that day. We go on. Here we now with this particular setup, long description about what we're going to do. I'm not giving an official call today, as I simply have to see how the day develops. So this is what you'll see once in a while. Look at this chart. I don't know what to do with that. It's a day where you got to, if you're trading the market, it's a day where you have to just go golfing or do what you want to do or wait till later in the day and you get some bars that form to figure something out. Why? Well, we went back into an hourly downtrend. It was a very weak bounce on the daily chart. It's hard to say that we're strong. You did retest this level. You had a nice bounce. You're still in that little hourly downtrend in there. That's going to be big resistance. We already bounced off of here. Who knows what's going to happen? Very hard day to say. So I didn't make any call that day. We ended up flying higher and pulled back. So what happens when you see that chart now? And I'm going to get through this pretty quick because some of you are getting bored. What do we do with that chart we have now? When I draw lines on charts, for those of you that are newer, technical analysis, these are not like gospel. These are not to the penny things. But there is this general concept. I mean, just draw some lines like my high school geometry teacher used to do. Whoosh, whoosh, and guess what? Nice minor support level. So the call that day, blah, blah, blah. Nothing triggered. The call was to play this minor support level long. We just didn't go anywhere, just sat there, didn't trigger actually whatever I said to do that day. The next day, just following up what we're doing here. Excellent trade call that day. I'm sure it was long, coming off of this new hourly tentative uptrend. Now, it's not an actual uptrend at that point, but you have this nice area through here that is support. You have this nice bullish wide range bar triggering things. You're ready at short covering out of the way, so that's just a pure buying bar, and we're back off to the races to the upside. And we go on, excellent call again, blah, 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 mega homer on this day, called this long off of this area. And again, this is a no-brainer day to me. I remember this day, just doing that. Sideways hourly chart, closed week, gapping up above some garbage, flew higher immediately. This is where if you say, hey, like Tag said earlier, let me see what happens, you're going to miss it because there's nothing to wait and see. It just flew higher that morning, done. Got nailed the trade though. Now I want to emphasize again that for me, the reason most of the time I specifically say here my bias for the day is because I'm usually not trading the futures of the market. I'm using this as my own bias as to direct me what to do with the stocks I'm trading to some degree. I'm going to talk about that more in just a second. From here we go again. Here I had excellent comments and bias, but my trade didn't trigger. I was waiting for some confirmation, and we just took off that morning. It was a bullish bias, said we're going higher, but the trade I called didn't trigger. Now, sitting there in real time, I didn't do the market that day, but if I was doing the market, I would have caught that day. But again, putting out a letter an hour before the market goes up, not knowing exactly where we're going to open and trying and telling you how to get into this, you know, it's not that precise doing what I'm doing. I think that's the last day. So what's the point of this, going through this? Well, it's one simple point. It says on the slide, technical analysis is absolutely incredible. Technical analysis is incredible. It absolutely positively works. Most people don't understand it, let alone know how to use it. This is something I have been trying to drive home since I started DTS. And I did a presentation a while back called Learning from the Internet, which is, it turned out to be a total mockery of what's written on the Internet. Not that I really wanted to do that, but you just objectively go out and read what's out there and look at all the 1-hour videos and the magic strategies of how to make money in the market. It's all complete crap. And people lose money hand over fist. When you really understand technical analysis and really understand it, it's not about memorizing strategies. This year I did a presentation about that. It's about learning how to read a chart. And when you understand it, it does an incredible job doing what it's supposed to do, which is getting the odds in your favor. There's no guarantees. It takes good management. It takes a good understanding of what you're doing. Outside of getting a great education, I don't run across people who really have a good understanding about what it is at all. Nothing. As soon as I hear technical indicator, you're out, you're wrong. No technical indicator in the world works to make money. Zero, none. Prove me wrong. Show it to me, send it to me. Nobody's done that in 8 years. AI does not make you money. Am I wrong? Prove it to me. Show me. It doesn't. AI admits it doesn't make money. Ask AI if it makes money. It'll tell you. No, it doesn't. So, as I always say, learning technical analysis is the way to do it. And if you want to follow along with a letter or something, that's great. If you want to learn to do it right, take the time to learn to do it right. And please don't lose money while you're waiting to learn, okay? This is not about the Daily Market Letter. If you want to get the Daily Market Letter, go to the website and figure out how to sign up if you want to. I don't care. That's not the point of it. The point of it is that technical analysis works. It just absolutely positively does. People that are in the room get the letters from me, take the seminar program. They're here. I don't lock people out. There's nobody here that would deny that, to my knowledge. Nobody's ever said anything differently. All right. Any questions on part one? That was part one. About it's right about on schedule. I planned on that being more than a half hour. Any questions about any of that? You certainly have a right to ask questions. This next one here I may lose my temper over, so you better ask them now while I'm in a good mood. You got the point of that. My dog couldn't do the last part of it. My dog could look at a chart from yesterday and tell you why it did what it did. You can make up anything you want to. And by the way, that's what they do on the news, you realize, right? I mean, I talk about it all the time. Big green bar on the daily chart. Oh, well, traders bought up the employment numbers this morning, even though inflation's going through the roof. We just won't mention it. Same thing you hear all the time. All right, I'm going to move on then, if we're good. Moving on. Point number 2. An email went out this week that raised some questions. I appreciate learning this. Looking forward to such future have. Well, Camille, let me stop on that a minute. Thanks for the comment. I appreciate that. I'm not here training you, really. Yeah, I know. But I want to be very careful. You're never going to learn how to trade coming to these. You understand that, right? And I'm not saying that to get you to sign up for something. I just want to be careful. Sometimes I feel like I'm giving people loaded guns that haven't had a gun handling class. You understand that, right? This is not, here's what I tell people. Okay, all right. Well, what I tell people, because this is always a concern for me, and it's been more and more lately even, is that if you read everything that was ever on the free stuff page since the beginning of time and attended every event and watched every one of those things, you would not have heard 10% of what's in the seminar program. I'm careful about that. And even if you did, even if you made an argument there was more than 10%, it's all discombobulated all over the place. So I just want to be careful. I'm glad you're learning, but what I'm really doing is kind of just showing off. I'm just kind of saying, hey, this is what anybody can do that wants to do it. So I just want to be very careful about that, all right? Because I want to, help people all I can. If you're making an effort to do it on your own, that's great. But you just got to be very careful and, send me some charts of what you're doing. If you're doing it on your own, let me evaluate them and tell you where you are. I appreciate the comment. Thank you. This is actually following such. Okay. Great. Okay. All right. Thanks again, Camila, because what it is great for, and I didn't finish up my thought, is the structure, right? It's the structure that matters. And when you hear me talk about how I look at charts, even if you don't understand exactly how I'm doing it, you understand that there is a procedure and structure involved that is very rigid and as objective as it can be. Does that make sense, everyone? I'm glad I got that out because that's really, it's really what it's all about to some degree. I always say new traders come to the market 100% subjective. And the goal is to make things as objective as you can when you learn how to trade. But there's always going to be a little subjectivity left. But just taking that first level from just, oh, that looks like support, oh, that's really extended, oh, that was really good news, and trying to trade like that is guaranteed to lose your money. It's guaranteed. All right. An email went out this week, raised some questions. It was a much bigger deal than most traders realize. There may be some yelling. A lot of points on this. I really felt like I had to kind of go and revisit this. I'm just going to pull up the email, which is my easiest way to do this. I did no slides for this other than the email. This is the email that went out. And it's a sarcastic title saying, I guess it was the war. This is about the Monday morning gap down. And I know some of you probably read this, and you read it quickly and said, oh, that's cute. And some of you maybe really read it intently, and some of you probably just clicked on it and clicked off it because you didn't really care. And you get a lot of stuff from DTS, a lot of free information, and I guess it's not rated, so to speak. Sometimes it's a little show-off trade or something, and sometimes there's some really deep-sitting meaning to this. This is so key and critical because where I sit as trying to train people, this is probably my biggest impediment right here. People in the seminar program get it because it's drilled into them. People who I'm just talking to and trying to get them to understand technical analysis, there is a roadblock for most people they can never get around. Does anybody know what that roadblock is? It has many different names to it. You could probably throw out 6 different names. What is the big roadblock most people have? And I don't mean to be insulting to anybody. I'm not picking on any one person or any group. I'm just saying from my seat, I see people that don't make it, that are never going to make it, and there's roadblocks they have. Okay, ego could be one word. I like the phrase that they have to be right. They have to be right. They have to always have an opinion and justify things. Expanding on that more, because ego really covers a whole bunch of things. Expanding on that even more is I think some people feel the need to work hard to make money. In other words, you worked hard all your life, you had a business, you did this, you did that, and you feel to make money trading, I can't just look at a chart. I have to go research it and understand it. A lot of people cannot do something, let's say research it and understand. Now that's great if you're buying a new TV or if you're buying a Bluetooth speaker and you want low latency, but in trading that's very detrimental to you. What else is there? What else is the roadblocks as I see it to people? I think they're all derivatives of what I just said to some degree. What else you got? Yeah, that's true. I mean, that's maybe a little subdivision. Maybe that's not the headline of this discussion right now, but yes, getting educated the wrong way and trying to lose that. But maybe it is part of it here, Gary, is that maybe being self-taught that I need to understand inflation rates. I need to understand if they're going to raise or lower the next fee. I need to understand what is the war going to break out? Are we have troops on the ground? I need to know all this stuff to make a decision. That's the kind of stuff that will absolutely kill you trading. Confirmation bias, yeah. I mean, that's a big part of it. And again, I did a whole presentation about confirmation bias and the other two psychological killers. But that's just it. I mean, you have a bias, right? You think the market can't be at this level and it has to drop. So you're bearish, bearish, bearish. I know somebody emails me once in a while that has the same problem. And anything that comes up, oh, bearish. You know, a war broke out. The market's going to, how can you possibly think long? We're going to war. It's got nothing to do with it. You know what I didn't put in here was I have some slides, and I meant to put that in here. And let me draw it for you. I'll have fun drawing it because we have all kinds of time tonight. So here's what I'm going to draw. I'm going to draw a house, first of all. Let me draw with the thicker. Here's a house. It's going to be just a 2D house. I'm not drawing a 3D very well, so complain if you want. There's a little chimney up here. On top of this chimney is a little blue container with something in it. We don't know what's in it. Up above, I'm going to put it in red. I'm going to draw an arrow to represent this. This is somebody taking a match or a spark and dumping it into this container of liquid. And we don't know what the liquid is. And the question is the house going to burn down? The match is news, right? The match is the news. Whatever news came out today, the war, inflation numbers, whatever it is. There are times where some news article will come out and the market drops for 7 days. And then the news people go, oh, I told you that inflation number is going to kill us. Well, what's in this basket is the chart pattern. And that chart pattern could be gasoline or it could be water, right? So if you drop a match on water, it just fizzles out and nothing happens. That's when you have news on a chart that already has a strong bias against what you're doing. So you're in a nice uptrend in the market, whatever it is. You're not overly extended. You just pull back. Bad news comes out. The market hiccups, and it just keeps going higher, right? Well, then you get to this point where the market is hyperextended. It's like, whoa, are you kidding? We're running out of buyers. And then a little piece of news comes out. Somebody says, oh, the Prime Minister of England, his dog just ran away. Oh, no. And the market crashes. And everybody goes, oh, it's the news. No, it's not the news. It's the chart. This is 100% proven all the time, period. There's only one time that news actually moves the market. What is that one time? Where news will actually change the market. Shock value news. In the market, in the whole broad market, there's only 2 times in my career we've had shock value news. It was 9/11 and COVID. Those are things that were not in the contemplation of the market in any way, shape, or form. What nobody seems to get is the market. I don't like yellow anymore. The market is the greatest forward-looking interpreter of all possible known events. It looks forward. It knows. Do you think that the war is something new? This has been going on for 35 years. Even the recent developments have been going on for months and months and months. It's not new. Inflation is not new. None of this is new. Let me ask you another question. Raising inflation, we're all, again, afraid of raising inflation. Is raising inflation rates going up? When the Fed raises interest rates, is that good or bad for the market? Just a simple explanation. When the Fed raises interest rates, is that good or bad for the market? If you had to pick good or bad, if you had to pick one over historically, what is it? Everyone else. All of you here, good or bad? There's a lot of you here. Good or bad? Don't be afraid. If the Fed raises rates, is that good or bad for the market? Yeah. Historically, if you look it up, the market has rallied during Fed increases significantly more than not. But yet, will you hear that on the news? No, of course you don't. But then, of course, when the market gets hyperextended to some crazy level where anything will make it drop, and then somebody whispers, oh, we may raise rates next time, and boom, the market drops, we go, oh, it's the rates. Well, what about the last 17 times you raised rates and the market kept going higher? Why do we ignore that and then go, oh, yeah, this one time did it? It's the charts that matter all the time, all that matters. Now, stocks, individual stocks, get shock value news all the time. What is it about stocks that they get shock value news? Because there's something that happens every 3 months. Yeah, earnings. Earnings are shock value news to an individual stock. because nobody knows where it's going to be. And the stock could be going up, and it gaps down 20%. Well, nobody saw it coming. The market, even when we went back and when we had the 9/11, that was not contemplated by the market. But after 9/11, there were several terrible terrorist strikes. Like London had 111 people killed in a subway from a terrorist, right? And if that would have happened before 9/11, that would have killed our market probably. That day in London, the market ignored it. It didn't even care. Why? Because the market learned, okay, terrorism's out there. It already built in its fear of terrorism on the drop. It built it in, and now it's in there. It's in there. You can't change what the market thinks because a new series of events comes up that's already been expected by the market. It knows about earnings. It knows about inflation. It knows about war. It knows about all this stuff. Now, if a big mushroom cloud developed over Washington, D.C. tomorrow, it didn't know about that. That would be shock value news. That would be devastating. But all this little stuff people react to is so crazy. And what I really want to get across is rather than sitting here and trying to, I get emails from people, oh, what do you think about the war? Oh, should I sell all my stuff? And blah, 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 blah. Well, number one, is war even bad for the market? If you look historically, war isn't even necessarily bad for the market. It's usually a knee-jerk reaction. And number two, are we in war? I don't know. Go ask a politician if we're in a war or not. But here's the thing. Despite all that, here's what I do, what it says here. By the way, I just want to show you also the difference here. This was, the synthesis that morning of why we gapped down. U.S. markets gapped down primarily due to intensifying geopolitical conflict between the U.S. and Iran, causing all prices to spike, driving investors towards safe assets. Additionally, fear was fueled by sticky inflation data and poor February performance and major indices and AI-related concerns. So once the market's gapping down, here's the reason why, everybody. What do you learn from that? Anybody? What do you learn from that right there? How do you trade that? Okay, the market's gapping down X amount today. Something happened over the weekend. Here's the reason why. How does this paragraph help you? Everybody. How does this paragraph help you in any way, shape, or form? What did the market gap down that day? $10. Let me look just so we can. We had closed at 606. We gapped down about $9 in the QQQ. Yeah, exactly, Gary. It's confirmation bias. Oh yeah, you knew this was bad. Blah blah blah. This doesn't help you at all. It's completely. Hi, Juanita. Doesn't help anyone do anything except to confuse you. Here's what the market letter said that day. You ready for this? And again, this was written before we opened. Where's the market letter? Here's the market letter today. At the moment, we're gapping down just over 6. And actually, we ended up gapping down 9. At the time I wrote it was 6. Trading below yesterday's low, but at support level. If this is one at all beneath the open, I don't think we're in any danger of really bearish day beyond the open. I think I bolded that for this so you could read it. The support level at 2, and you don't see the chart here, is a dotted line, means questionable, blah, 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 blah. It's also most likely, I feel, that we'll see a green bar coming up in the morning this morning. That's exactly what happened. Where in here did I refer to the war, the news, inflation, AI? Do you see that in here anywhere? You never, if you go back through 500,000 letters I've written, you'll never see that anywhere because it's simply not relevant. Yeah, that's the knee-jerk why we're gapping down. Who cares? The question is not why do we gap down. The question is where we're going from here. This is the point, and it is a big point because I know when I talk to people, they're confused by this. And here's the big deal this day. I didn't care about, me as a person, sure, I'll go listen to the news and hear what's going on as a person. As a trader, I didn't listen to anything that morning. Here's what I cared about. Here's some little chart, a stock, that I really like the chart pattern of. I'm not going to go into why. I just loved it. I did this in the trading room. People in the trading room Monday, right? And this isn't really a show-off day. I wasn't here showing off per se. It was just that this is the day the market had this big thing and everybody's scared and how can you possibly go along? Yeah, it's such a nice setup. And here's all I care about. Here's a little stock is doing this, this, and this. I don't care about anything else in the world. Nothing else in the world. Find a chart, find your bias, get the right time frames, find your entry, manage it well. And then a second one is almost the same type of thing. A little different entry on this, ABR. Who cares about anything else in the world? Just find some nice charts and trade the charts. This leads to another little topic, which is something I've harped on before a lot, and that is, are we done with this? I think we're done with this. And that is just very simply that I feel there's such a huge advantage to trading stocks because of this. Because if you're trading, now people say they're trading the futures are a lot of things. It's gold, oil, cotton, pork bellies, Eddie Murphy, orange juice. But generally, I mean 95% of the time people say they're trading the futures, they're trading the market is what they mean most of the time. And if you're trading the market that day, well, I would have had it right, but I wouldn't have been real confident about it. It's not like I wanted to take a trade on the market. I was just saying, well, here's where we're probably going to go. Here's my bias. I like to find a stock that coordinates with that bias. But trading the market, I trade the market sometimes, but it's maybe once a week, right, Eric? At the most, I probably trade the market because the rest of the time stocks are so much easier. So I'm only calling it Eric because he's talking and he's in the room with me, but it's just so much easier because you have this variety of stuff. And no, it's not work. It's just simply easier. A lot of people trade futures because of some of the inherent advantages. They're very liquid. That doesn't count. There's no stock that I trade that is liquidity is a problem. You trade the top 300 stocks, you can get 1,000, 2,000 shares anytime. It depends on the stock. But I mean, generally speaking, yes, there are stocks that you can't trade very well, or they're not on my screen. I don't care almost what risk you're taking. Anything up to a $2,000 risk, you can trade stocks just fine. So if you're a mega $5,000 risk per trade person, fine, stay with the futures. You want that liquidity, whatever. There can be some tax advantages, but I'm not an accountant, but tax advantages aren't very good if you're losing money. The biggest thing people say, or the reason they do it, is because you don't have to have $25,000 in a day trading account. But again, 90, I forgot the number, 94% or something. There's a lot of these percentages around the mid-90s. 94% of all futures accounts that are under $6,000 never make money. They just keep getting replenished with money. Add 2,000, add 2,000, add 2,000. That's all that keeps happening to them. Because these are people that are trading futures, not because they want to, but because they have to. And I just want to keep harping on it. Now, please, if you trade futures, you're making money, fantastic. I'm not at all against you. That's great. I'm not harping at you. I'm harping at new people that just keep losing money because futures are hard to trade. They just are. Why? Because I have dozens of stocks I look at every morning. I mean, I whittle it down to a few dozen stocks, a couple dozen stocks. I started looking at more than that, and I can pick my favorite things. The market, here it is. Take it or leave it. There you go. What are you going to do with that? And you have to have incredible patience. And I don't care if you're on a 2-minute chart. You still have to have incredible patience. People tend to overtrade them. They tend to trade when they shouldn't be trading. And I just want to warn you about that. You're not learning anything if you're just taking pot shots at the futures all day long and you're not making money. There's a big advantage possibly coming up. Over the weekend, I'll probably send an update about this. This PDT, I don't know if some of you, I haven't talked about it in a while. I did at the end of last year. The day trader rule that requires $25,000 is coming. It's coming. The latest update, and I forget between FINRA and SEC, I forget who writes the rule and who has to approve it, but the one that wrote it, and there was a time to approve it. The body that's got to approve it said, we're going to approve it, we just need another couple weeks. So they set a deadline, end of March or something. I don't know what it was. SEC has to approve? Okay, thanks. And it's, from all I know and understand, it just has to be approved. April 14th? Okay, so there's the deadline, April 14th. So it's 100% expected to be approved. And I think this would be a great thing for people, for traders, because the PDT rule is the worst thing they ever did to traders. People just lose money hand over fist since that came into place. So you'll be able to day trade stocks. And some of the recent trades I've been putting out, it's called the Fun Trade of the Week. I've been sure to include in there how much capital was needed in a day trading account. I mean, a lot of these stocks that are making, at a $500 risk, they're making $1,200 or something. They only require $8,000 of money, of capital in a 4-to-1. So you can do what you need to do and have the variety and actually make money instead of, bragging about all the liquidity you have just to lose money with futures. Again, if you're making money with futures, that's great. I do futures sometimes, love it. To me, it's a very difficult road to go down. So hopefully this will open the door for a lot of people. I will keep you informed naturally as that happens. All right? Questions? This last half hour I have devoted to talk about long-term trading and specifically the long-term trader. So this is kind of a half, little bit educational, half little selling thing for the long-term trader. Part of it is kind of some rules and misconceptions I get from sometimes. So I want to go through this, and I'm probably going to go through this best just from going through the website page. First of all, let's talk about long-term just in general. Anybody who is day trading should have both a long-term and short-term account. If you're just long-term, that's all you need. That's fine. The terms day trading, swing trading, core trading, long-term trading, all the terms. We all know day trading. I'm not going to explain that. You're just trading during the day. And if you're able to be free a couple of mornings a week, I think you should be day trading. Start out just making a few bucks extra income every week. Learn how to do a few things. The level of that is swing trading. That's what a lot of people end up doing because it's kind of the shortest term but holding overnight. And it's for people who aren't able to be with the market. I have a video on the free stuff page about swing trading, and it doesn't talk very nicely about it. It says that it's highly unlikely you're making money swing trading if you're not with the market in the morning. Now, if you're with the market in the morning, totally different story. That's great. But if you're trying to trade, working a job, you're putting in your orders before you go to work, it's highly unlikely you're making money, and if you are, it probably won't last for long. It's very difficult to swing trade. I know you probably heard differently because your broker or whoever will tell you swing trading is the place to be because they want to keep you active. Here's the, let me give you the link for that. So I'm not a fan of swing trading if that's all you're doing and you're working another job somewhere. Above that is, I just call it long-term investing, long-term trading. Trading, investing, same thing to me. Long-term trading, people used to call it investing. I'm not going to go through the distinction, it's semantics for the most part, but just understand you no longer should ever be hanging on to something forever just because you like it. You have to manage things. That's why the term trading. So long-term trading, and core trading is just a little colloquial term that maybe is the shorter portion of long-term trading. Long-term trading would include holding stuff for years, weeks, months, years. And core trading is kind of like, hey, I'm holding weeks to maybe months, but that's it. It's not like a forever thing. You're taking profits a little quicker. And right now, I think I'm pretty much kind of more of a core trading because long, I'm not planning on holding the stuff for years from where we are right now. And you're never planning on holding stuff short for years because bear markets typically come 9 to 16 months or something like that, and that's about it. So there's the terms. Important things about long-term trading is defined risk, number one. So many people that I see the mess that they have that they're sitting with, they don't have any kind of defined risk. They're just buying stuff all over the place. A famous story of a guy that, well, infamous would be the right word, infamous story of a guy back at one of the crashes that we had. He shows me what he's doing, and he said, I know not to add to a losing position. I didn't do that. And what he did was he had Dell computer, and the market took a hard hit. He was way underwater. So he bought Microsoft. Took a hard hit. So he bought blah, 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 Broadcom. Just kept buying all the same type of stocks, and he just got decimated. Well, that's the problem. You have to have very controlled risk. Safety first long term. You have to understand that things can gap against you. They also can gap for you. If you play things right, you should have more things gap for you than against you. But you never want to go kind of, just crazy into an earnings report or crazy. I never hold a biotech type stock, not a crazy biotech. And you do want to try and hold through earnings if you can, but you got to be seasoned. You have to have some equity. You want to be the case that maybe you're giving back profits if it gaps against you, not going big negative. So safety always has to be first when you're long term. You have to understand about share size and exactly what you're doing. The same rules as anywhere else, but there's other rules you need long term because you don't want to devote too much to any one part of your account. Even if you were to theoretically say, hey, I'm risking $1,500 a trade, and that allowed me to take 4,000 shares of IBM. Well, that's not going to work well probably because maybe 4,000 shares of IBM takes up 30% of your account. You don't want to do that. You want to also have a restriction on how much of anything goes into one account. So safety always first, defined risk. Let me pull up and just kind of review some stuff on here right now. I have so many questions on this all the time. The long-term trader is designed for somebody who wants to be involved long-term. Here's the opening paragraph on it. But isn't good at picking their own stuff and or is maybe sick of their guy who they don't feel is doing well. Or what a lot of people are saying right now is, hey, my guy's been doing okay, but as far as I know, he's just going to hold through a bear market, and that's what a lot of people do. And they just say, well, it's a bear market, what do you expect? It depends where everybody is. Let me back up and tell you another story. My opening podcast I did, I talk about what is perhaps the smartest thing to do. And that's when you were 20 years old, if you just started putting X% of your check into the market every single paycheck, and you've done that since you were 20, and you've seen a financial planner, and you're 45 and you're on track for retirement, you just do what you do and don't listen to anybody. You're fine. The problem is, again, 95%, I think it's 92% of the world is not in that situation when they're 50. In other words, 92% of the people when they're 50 are not on track to retire. And that's where you get in this bad situation where they have to accelerate the money they're making, they take additional risk, they do it the wrong way. If you put your money in the market, it took 17 years to come back from the 2001 crash. If you're in your 50s, that's not going to work well for you. So you have to be very careful. Financial planners are great, but at an older age, financial planners will say you can't put your money in the market, it's too risky. Well, it doesn't have to be risky. You can do the market a certain way. Financial planners just put it into a mutual fund. You're going to get your butt kicked if it goes down. But if you keep legging into individual positions, both long and short, that are unique positions that are going to be doing okay. Right now, the long-term trader, the longs, and by the way, I'm at a fairly minimal number of positions. We just have 3 positions. And they happen to be longs at the moment, but they all have been going up when the market dropped every time, for the most part. I mean, don't quote me on one day, but I mean, they're all doing really well because they're unique positions. And I want to work in shorts as we get to certain areas I have before, and all revolving around a market bias. So it's great for somebody who, and if you have a lot of money somewhere and maybe your significant other says, hey, I just want to leave it with Bob because we've had him for years, take some of it out. Just kind of start testing and just say, hey, let me manage 10%, 20% of our assets. I'll use the long-term trader, do it your own, wherever you're going to do, and see how you do. It's one thing to be able to kind of keep up with the market in a bull market. It's another thing when things turn. And you want to be very careful about not losing money. It's never acceptable to lose money, not big chunks over a period of time. Nothing really special to say here. I want to get to the rules real quick a little bit. Oh, I just got reminded of something. Somebody told me this 2 years ago, and it's still true. There is a fund, not a big fund, it's a small fund, but there is a fund where the person obviously subscribes to this letter because somebody emailed me. They know somebody who subscribes to this fund. They were just talking. The person subscribes to Long Term Trader. He has a friend, and they talked about what I did in the Long Term Trader. The guy said, oh, it's funny, I just got in that too. They compare notes. There's somebody actually stealing my trades from the Long Term Trader. Can you believe that? A fund. Some fund is, and they still are. Now, they do other stuff. They do more than I do. But every trade I put out there, they're putting in their thing. Let them have it. That's fun. That's fine. I just thought it was kind of funny. And I have no way of knowing who it is because they don't sign up as the blah, blah, blah fund. They're just some person who owns it or works there and who knows who it is. This is, you get probably a couple of letters every week. Sometimes there's general updates. I forgot how many trades there were last year. There were maybe 50 trades last year. I forgot. I should know that to tell you. But we're just, it depends a lot on the market environment, the situation. There's times where you kind of want to get involved more. There's times we've been more sideways. I've been more laid back in the sideways market like we've been. It's been tougher to find the right things or to get big moves. The toughest thing for me is finding the big moves on some stuff. Even looking at unique stuff. Basically, if you're interested in this, you get an email that comes to you that's very clear, concise, that simply says, here's the stock. Here's the entry price you need to have. Here's the stop. Here's what the target's going to be. And then I update the management as needed throughout the whole thing. You also get a text. If you have a US-based phone, you get a text. The text just says, look, check your email. You don't want to repeat everything in the text. And it's then fully managed. And then you get updates all the time and exactly what the positions are, what they were in the past, what you currently are, what's open, what the management is, all that good stuff. And you continue to get general updates. You could have new positions that come out. You could have position changes. Now, there is something you get with it also, and it's a set of rules. And I'm not actually going to pull them up here, but there's a link that gives you a set of rules. And I've had some pushback on the rules because sometimes people say to me, boy, these rules are kind of complicated. So there's a video you get when you sign for the long-term trader along with the rules. And the video, it kind of just says, look, here's the reason there's the rules. And I'm going to explain why there are rules. But here's the other thing, is this is your money. You still make the decisions, right? Here's the recommendation, right? Get long over this. If you want to do that, you don't do it. If you don't want to follow the rules, you don't follow the rules. I'm not going to show you the rules because a lot of people have said to me that the rules themselves are worth the price of admission for a whole year subscription to Long Term Trader. The rules are a collection of my knowledge and experience over years and years and years of how to handle things. Now you may be saying, what's there to handle? There's a position, you go long over some number, you go short under some whatever it is. Well, that's easy when that's how it happens. But what if you're looking to get in a position and it doesn't trigger on day one, and on day two we want to get in over 1366, and actually in the real letter it says over the number there. This is just a little shortcut thing here. Over 1366, and what if it gaps up to 14? Do you just jump in? What do you do in that situation, everybody? What do you do? You're supposed to get in over 1366, opens at, well, 14 is over 1366. I guess you just jump in, right? If it opened at 17, if it opened at 30, what do you do? What if it opened at 1371? What if it opened at 1382? What do you do in all those situations? What do you do? I've been talking a while. I'm going to have a sip of Coca-Cola. Anybody know? What do you do? It gaps over your entry. Yeah, well, that's just the thing. In a day trading room, you can ask Paul. In a long-term trader, it's 9:32 in the morning. You're trying to get into a position. You can't ask Paul. So what you do is you turn to the LTT rules, and they're very specific. If it says if it gaps less than X percent, you just jump in. If it gaps blah, 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 you wait for this. If it gaps more than that, you do this. If it gaps more than this, you forget about the trade. So it gets a little complicated, but 90% of the time you don't need the rules because it's just, hey, trade triggered, I'm in. Trade hit target, I'm out. Trade went under. What if you gap under your stop? What if you have a stop? Where's the stop? 1284. What if you gap down to 12, to 1250, to 11? What do you do? Well, all those rules are spelled out. They are the highest probability rules that I can say ahead of time. Now, naturally, any single stock, anything that happens, you know, that particular morning, the rule may not work perfectly, but over a long period of time, these rules are a lot of experience and knowledge have gone into making these rules to make them work. Now, if you don't want to use them, don't use them. Just do what you want to do. Get in, don't get in, I don't care. But there's a second reason also, besides giving you the absolute best knowledge I have about how to manage things. The second reason is I have to have a way to be able to track the long-term trader, right? I have to be able to have an objective way to say, how's it doing? I can't just say to everybody, well, you know, it gapped up a lot that day. I didn't enter it, and that's how I'm going to track it, obviously. So the rules have to be there and followed precisely so that I have an extremely accurate tracking mechanism. All the people that get it, you know, whether it's a trading room or the long-term trader, there's always a big handful of people that are very good about calling me on anything that's a little bit off, whether it's in favor or against the favor of the LTT. Always have that, so it's very, very, very closely, you know, monitored and make sure it's accurate. Those of you that know me know I cherish being accurate more than anything else. So, what other comments are there here? Yes, you get a text message. How it's managed, talks about it. Again, you can go to the site. I will give you this, and you've probably seen it. You got an email. You're going to get another one. There is. For the new people who want to get involved, there's just a little tiny discount you're getting. And if you're, I'll send it to you as you're getting the long-term trader too, the LTT. Those of you getting the long-term trader, I'll send it to you too. If you want to, you know, up it for another subscription time using this, you can. But most of you are probably under that anyhow because there was a price increase last year. Just taking it back to last year's price. The chances are you're already under what is being offered to new people at. But I'm always very sensitive about that, about not any sale that's going to hurt anybody, that type of stuff. So take a look over it. Yeah, it's the big thing. It's not just recommendations like I showed you with the Daily Market Letter day trading earlier tonight. A list of ideas doesn't help you. This is the exact entries, positions, stops, full management, up and down, the whole thing. And when you sign up, of course, you have access to the closed positions that are here for the year, and also you have the closed positions for the last couple of years, so you can go study those if you want to. If you go to the link I gave you, you can see the performance over the last 5 years since I started. The LTT did not start when I started DTS. I initially didn't have it. I used to do it at the prior company I was at. I had a lot of people that loved it at the prior company. They asked me to do it, and after the first year, I started it up. The very first year I started late in the year, it was plus a little bit. I didn't put that on the site, and then every year since then is out there if you go look it up. What else? Any questions about it? It's 6:20. It's really all I have to say on all these topics. Any questions on anything tonight? We talked about intraday market bias. We just talked about the long-term trader. And in between, we talked about an email to me, which I felt was a very important concept a lot of people don't get. Questions? Well, I came close to yelling during the middle part. Yeah, I don't think I actually yelled. I'd have to call Janet if I really wanted to get into that, but didn't. You called me when I was jogging the other day, didn't you? Isn't that you? Or is that a different Gary? You see what I did there? Yeah. Well, the way you spelled it, too, I thought that was intentional. I would not have Janet Yellen as a guest, no. Not unless it was about how to cook a pot roast or something, if she's a good cook. What's that? Huh? What are you talking about? And now for something completely different. Is that a new title? Oh, Yellen. Yeah. It's just, don't get me going down that road. I don't know how we pick some people. In LTD opportunities, we already have succeeded. No, here's what happens, Vero. And thank you for reading that so closely. I'm trying to get some general guidelines about what to expect to be maxed out. And what happens, though, is that's kind of like a 6 to 8 full position type of thing would be what I would consider to be maxed out. I've been there a few times over the years. But if I have that and then I sell a third, I sell a half, or I bring the stop up dramatically on one, that opens the door to do more. Because what I eventually like to be, VRL, is like from 2010 to 2022. That was the time where you want to keep hanging on to back there. I'll give you this philosophy of what I do, and that is for truly long term, is that, and by the way, the long term trader, I'm very, very high sharp and lower batting average. My sharp is the prior years has been close to 4 most of the time. So I like to get that first target, a nice healthy target, maybe a 3 to 5 hour target, depends on the chart where it is. And the second third, you hold till it's painful. As long as you can, manage it out. If you're in a true long-term situation, which we're not, the third you hold forever. So the idea of VRL, long-term according to Paul, is that you continue to collect those thirds that are way in the money. You see what I'm saying? So you keep layering in like that. And then if you do get a run that lasts for years and years and years, you've got those back thirds you're just hanging on to. Because most people at the end of a truly bull market run have nothing because they sold most of it. I mean, there's some other extremes that'll hold to the end of the bull run and hold it through the bear run also. So that's kind of the philosophy out there. And that's what I'd like to do. It's not as frequently happening here because here I'm more likely to take that last third sometime because I don't see the market running higher for 5 years. I've never, to answer your question directly, I've never been in a spot where I've had to say, well, I'm just not looking because I'm full. That's never happened. Because I would almost certainly be more generous in taking a target to add something new if things were, all crank in the right direction, we're going higher on a good pullback, that type of stuff. All right? Any other questions? It is absolutely both long and shorts. Absolutely both long and shorts, yes. It really depends a lot on what's available, market bias, unique patterns, entries, that type of thing. Yeah. Sometimes, I got to be honest, sometimes I get scared. My fear, and a lot of you don't appreciate this, but my fear, if I'm leaning too bullish, is that one day something happens, we have a big gap down. It can be very hard to get short in a bear market when it happens quickly. And I'm very sensitive to that because there's no way I'm going to lose money in a bear market. And I'm always very sensitive to that. I feel very naked when I'm too bullishly biased. So I'm always want to have that balance out there. The unique shorts whenever the market's at an area where I think it's time to be careful. See you in the trading room if you're in there tomorrow. There's nothing going on this weekend. See you Monday for scanning. You'll get your emails. And you'll probably get a couple of emails over the weekend. Have a great evening, everybody. Take care.